Hi everyone, Scott Schweiger, back with another Tuesday tax tip. Last week we did a little crash course on virtual currency taxation. This week we're taking a look at COVID-related relief for retirement withdrawals. So last year, qualified individuals could take coronavirus-related retirement withdrawals and loans. So that's a mouthful. I'm just going to call them COVID distributions from here on out, okay? There were a few ways to qualify for COVID distributions. First, there was the easy one. If you, your spouse, or one of your dependents was diagnosed with COVID, easy peasy, you qualify. And then there's if you, your spouse, or a member of your household experienced adverse financial consequences from, and there's a whole long list of things. Things like if you were quarantined, if you were furloughed or laid off, if you had reduced hours, if you were unable to work because of childcare issues due to COVID, if you had reduced pay or had a job offer delayed or canceled because of COVID, or if you owned or operated a business and you were closed or shut down or reduced hours throughout the year because of COVID. Those would all be reasons that would make you a qualified taxpayer to take a COVID distribution. Now, if you were one of those qualified people who did take out a COVID distribution, you have a few tax benefits and some decisions to make, really. First, there's no early withdrawal penalty on your distribution, even if you're not of retirement age. So normally there's a 10% penalty on early withdrawal, and that's not there anymore. And also the 25% additional tax on certain simple IRA distributions also does not apply in this case. So little benefit, yay. Second, you can elect to stretch out the recognition of that withdrawal over 3 years. So why is that important? Because even if you avoid the penalty, if the withdrawal would have been taxable normally, there's still regular income to be taxed. So you may want to talk to your tax pro, or if you don't have a tax pro, about planning for that income recognition. Taking a $100,000 hit in 1 year typically doesn't end up in the best situation, but everyone's a little bit different. That's why we plan. So third, you have 3 years to recontribute your COVID distribution. If you do this, you can treat it as a qualified rollover, and it's not all or nothing. You could, for instance, recontribute half, and then half would be a qualified rollover. Now, why would you do this? To be blunt, because a rollover would not be subject to tax. And this means you can claim a refund for the tax you previously paid on the distribution. We're a word of warning here on the recontributions though. You need to recontribute to a plan that would normally be a tax-free rollover. So taking a traditional IRA distribution and recontributing it to a Roth IRA wouldn't work here. Neither would taking a COVID-related distribution and then recontributing it to, say, a child's IRA account. Wouldn't work either. And yes, I mention these because I have seen some terrible tax takes online suggesting you do these things for various reasons. Obviously, how this tip will impact you depends on your particular set of facts and circumstances. Like, did you take a COVID distribution or not? If you have specific questions, please reach out to your tax advisor or feel free to contact me directly. Thanks so much for watching. I hope you join me next week for another Tuesday Tax